Good morning. Welcome to the XM.com weekly market update. And with me once again is the CEO of XM, Peter McGuire. Hi, Pete. How are you?
Oh, good morning, Andrew. Greetings from Dubai.
I know you're certainly a long way away, but what a week. There's been plenty of activity, obviously in the geopolitical area, but on the markets, a lot of volatility at the moment. So let's get right into it. The Australian dollar, which we spoke last week, that was heading south. It had a miraculous 1 cent recovery earlier in the week. And then all of a sudden, on the back of the CPI numbers in the US last night, it's pretty much given up all of that.
Absolutely. That US dollar's really, had a rocket boost to the upside, and that Aussie's been crushed, Andrew, sitting at around 63.20 at the moment. And there's every chance you're going to see a 62 handle sometime next week. It just seems to be in a big downdraft. And when you look at that chart, you look where it was this time last year, and it's nearly a mirror image. We might get there as far as, that 62.
Yeah, and I must admit, there's not a huge amount of positivity coming out of the local markets, and the ASX 200 is pretty much flat for the year as well. So there's not too much love in the Aussie equity market either. But yesterday we had the Westpac consumer sentiment come out. Now, if you look at that chart, it's a pretty dire situation. The numbers that came out yesterday were significantly higher than what the forecast was, but there's no doubt the consumers domestically here in Australia are certainly hurting a bit at the moment.
Absolutely, and that's been demonstrated, the high interest rates and the impact it has to, the wallet and the purse, how much spending power there is left in as far as horsepower. So, yeah, but that was as you mentioned, off air, it was down. I think it was forecast to be -1%, and you've shot to around about 2.7% to the upside. So that's a big difference, and that's a positive tone moving into Christmas.
Yeah, and it could, and once again, I think coming out of September as well, September traditionally is a really bad month on the equity markets historically. So and interestingly, October, bar what happened last night, had been quite positive so far. But anyway, we'll wait and see how that plays out in the next few weeks. China, once again, we've been talking about China quite a bit recently and some of the nasty numbers that have come out of there. But have we bottomed there? There seems to be maybe light at the end of the tunnel if we put the property market to one side.
Well, yeah, yes, exactly. But it makes up such a huge component of GDP. But yes, if you put it to one side, and then I would think that you might have seen it bottom out. We've just got to see, as far as domestic demand and naturally, who are the end consumers of their goods from an export side. People still going to be buying those US, consumers, global consumers buying those finished products. Time will tell, and this is where we head into the end of 23, that final fourth quarter, and naturally into 24. Everyone's got an opinion on 24, but we've just got to see how it materializes. But I think it's going to be, continuing volatility.
Yeah, it looks that way. And we look at the UK as well. The GDP numbers came out, which was slightly positive, which is obviously a good thing. But I think overall, the economy there in the UK is certainly struggling.
Yeah, exactly right. And that's been felt in the pound, Andrew. It's been punched lower, and, it's really in the doldrums a little bit. So it's just again, a work in progress. Where are they over this quarter? Is the Bank of England prepared to raise rates again? They've been very, very aggressive, and that's certainly had an impact as far as to the consumer over there. So again, we've just got to wait and see how they move in not only October, but certainly in November for the lead up to Christmas.
Yeah, for sure. We look at the US bonds. This is where all the activity is. We look at that US 10-year Treasury as well as the US dollar index. No surprise that they're tracking one another fairly closely at the moment.
Yeah, exactly right. And the Fed, their meeting, I think it's the 1st of November, 28% probability of a rate rise. So if that was to, if they did hit the go button, then there's every chance you could see that 10-year, Andrew, punch through 5%. So everyone's, sitting here. We're going to see how the next couple of weeks materialize. And that US dollar, it was around that 107, gave back a little bit, and then bounced again to 106.50. And if they were to raise rates, then there's probably, a 108, 108.50 sort of handle.
Yeah, well, it could be an interesting 3 or 4 weeks because, as we discussed off air, we're moving into earnings season again in the US. very soon. Yep. The banks come out shortly to give us their numbers. But once again, it'll be really interesting to see how these companies are performing, particularly the big tech companies. Are they still sort of holding up their end of the bargain, and just how the greater economy is performing? And a really good bellwether of that is obviously the banks, because they really can see what the man on the street is going through. So I think over the next week, when we get the banks' earnings, should give us a bit of indication of how things may play out for the next couple of months.
Well, exactly. We've got three of them before reporting this evening: JP Morgan, Citigroup, and Wells Fargo. JP will be the best performer of 23. It's a blurry sort of finish for Wells, how they've gone. Citigroup, well, it'll be another tough earnings season. Yeah, they're great. While they perform well with high interest rates, the consumer hasn't started to default yet, but that's the curse with high interest rates. And they're starting to say that could be, looking forward into the next quarter, how that performs as far as consumer strength.
Yeah, for sure. Once again, I think the title of this slide sort of sums it all up, whereby for quite a bit of the year, the share prices were pretty much doing the opposite of what they would normally do in a rising interest rate environment. But that's certainly changed in the last couple of months, where they're now starting to sort of track what the 10-year treasuries are doing.
Yeah, exactly. And, for the viewers out there, just study that chart a little bit, because on the left-hand side is the 10-year yield, and on the right-hand side, naturally, the stocks. But as the yield increases, then traditionally, it's risk off, and just, lay by the banana chair and, put the dollars in the bank. So it'll be interesting how that again plays into earnings season and performance in the fourth quarter for US equities.
Yeah, that's right. And once again, people are now getting a return on their fixed income, which hasn't been the case for a long, long period of time. So finally, the oil. Wow, another market which I'm sure your traders, Pete, love these sort of markets and this volatility, where it was all the last few weeks, we've just seen it continually go up. And then all of a sudden, in the last sort of 7 to 10 days, it's come off significantly. And then obviously we had the situation with in Israel as well, where there was a spike on the back of that. But the day traders would probably be loving these sort of markets at the moment.
Oh, yeah. Really since about the start of July, Andrew, it's been, as the chart demonstrates, it's been one-way traffic. And as you said, it got to October and then it really fell off that cliff, gave back a huge amount. And I was at a conference on Tuesday and Wednesday in Fujairah, which is about an hour and a quarter outside of Dubai. And the Secretary General of OPEC spoke and presented OPEC's figures to the outlook of 2045 and 116 million barrel a day as far as consumption. So you can imagine, not every meeting do you get the Secretary General of OPEC at. And it was a very closed forum, and I was very privileged to attend it and speak there. And I think most traders, if you're looking from supply and demand sort of side, most traders are thinking that they're probably to the upside for the rest of this quarter because of those cuts. But as you mentioned earlier, the war premium that was built in with Palestine, Israel earlier in the week, and then that's dissipated a little bit. We don't know, one, how Iran plays into all of this. Secondly, US, and thirdly, whether you're still going to see those continuation as far as cuts or consumption. So it's a wild market, and volatility is just incredible.
Yeah, and I think you're right there with what's happening in Israel at the moment. Does that conflict spread? Hopefully not, because that's the last thing anyone wants. So time will tell, but I think it'll be an interesting couple of weeks, and as I said, on the back of what's going to happen in the US as well. So once again, another interesting week, plenty coming up moving forward, and we can regroup again when you're back in Sydney next week.
Yeah, I look forward to it, Andrew. I'm heading over to Cairo this evening, and I'll be there on Sunday to talk to Bloomberg from their Cairo studios. And I want to get a lay of the land as far as, because it's very close to Israel, and, the mood and sentiment. So, we'll just see how that all rolls. And I'm looking forward to seeing the pyramids.
Yeah, very good. All right, well, safe travels, and we'll catch up next week when you're back on home soil.
Thank you, Andrew. Take care. Cheers.
Thanks, Peter. And that's the XM.com weekly market update.